Hey everybody, welcome back. Well, we have a lot to go over tonight. I've got some great slides to show you on what's going on with the Magnificent Seven so you can make a more informed opinion. And we need to go through what is going on with CPI tomorrow. I'm going to give you a range and how to determine it. It's going to be a wild one, and I'm going to say this because you saw what happened in Michigan consumer sentiment. You also know where you are on the 10-year, right? You're back above that 450. Don't forget that. Very quickly, 25% of you guys are not subscribed to the channel. Remember, these videos, they follow day to day, plus the public one that we do that's live for tomorrow for CPI. So you're going to want to make sure that you hit the subscribe button. If you've been watching these for some time, you know they come out at different times of the day. So you're going to want to be aware of that and just click the button and we'll go from there if you want to follow along. You got to watch 450 tomorrow, and then you're going to want to watch how TLT acts on this. We're going to go through some of this in detail, but first let's get into the Magnificent Seven and look at some slides that I found fascinating. One of the things we're starting to focus on more with this channel is getting more research out. And I do a ton of reading, as some of you know, and I do a ton of research as well. And reading some of these hedge fund letters that I get access to, I found some interesting slides. None of this is proprietary. It's all public information, and the way they just consolidated it, I think it really explains a couple things that are going on out there. So I wanted to share what I think are the top 9 that I came across. If we look at free cash flow margins by the decade for the 10 largest stocks out there right now, from 1952 to 2024, you can just see how we're all piled in here right now. But if you look at this, what they're saying is, hey, where are margins by the decade for the 10 largest stocks right now? And you're seeing that you are between 25 to 30% for these names. Never in history have you been here. And I just want to point something out when people talk about .com and you start looking at the 90s, or let's just take 2000. You were roughly at 15%. And right up here, let's call it 27. You're roughly 2x what you were during .com, meaning for every dollar in revenue that comes in, you're making an extra dollar than you were in 2000. Even companies like Microsoft, when you really think about it from that perspective, Microsoft is literally making 2 to 1 what it was making before. This is pretty unprecedented, and it's one of the reasons why you're seeing money flow into these names. So we see a lot of these kinds of charts where the top 10% or top 10 companies on a percentage basis, they're through the roof. And then everyone goes, oh my gosh, they're so high and they're the largest concentration ever. And we haven't seen this since this date, and yada, yada, yada. And yeah, we are really consolidated. Is that a reason for the market to just drop? No, it makes 0 sense, because you can make the argument from 23 on. Where you have an argument is if someone wanted to say, oh, you have some antitrust issues with Microsoft, Apple, Nvidia. That I get those arguments. They're legit arguments. But saying that these stocks are too high is silly. If you're saying they were too high here, or if you're saying when you're over 2000, were they too high here? You can just go on and on with this argument. It's not really a valid argument. And it's not a real reason for stocks to just drop because one name is so big in the group. I thought this was pretty fascinating, so I wanted to share it. So in 1964, AT&T, GM, Exxon, IBM, crazy IBM's still around, right? And it's still hitting highs. It's absolutely crazy when you think about it. Apple, Nvidia, Microsoft, Amazon, Alphabet. So the last time the top 5 were in that space. And then again, you're going to say the same thing. Oh, well, that's crazy. Well, if you go back to this period in time where you didn't even have that many names, to this period in time where you're pretty much at like 3 or 4x the gross margins, and we're just going to hop back here for a second. So in 1960s, what they're saying is, oh, this is crazy. The last time we were here was 1960s. Well, you had negative cash flow margins then in the 1960s for those names. Look where you are now. So when you're doing this comparison of apples to apples, the reason I'm overlaying this and going back to the cash flow margins is you're not comparing apples to apples. You're comparing apples to oranges. It's not the same thing. You're taking a cash flow, negative cash flow by margins, corporation, and comparing it to companies that are doing 27, 28% in cash flow. And I'm not saying that they can't come down. Of course they can. What I'm saying is these comparisons, you have to look at them and compare the actual process and what they're making. And if you're not doing that, it's a real issue. So if we take a look at profit margins on a quarterly earnings basis, and this is where, to me, it does get interesting, because what they're saying last quarter was 23.5. And the average company right now in the S&P, if you take them out, is 9.3. But you are seeing this, and this can affect the name. So really what I'm trying to get to the point, people will say, what's the point? Because they don't want to think for themselves. The purpose of these videos, guys, is to get you to think for yourself. If the margins start dropping here, you see how they're going sideways, and the margins for other names start increasing, they will sell the Magnificent Seven and they will buy these other names. You are starting to see signs of this. And I just want to be very clear here. This is your first quarter that you are seeing where this is starting to happen, where the Mag 7 are going sideways on their profit margins. You can go back and revert to that other slide. This is from JP Morgan. And here, the rest of them are increasing their gross margins. Now, this to me was suspect, but I wanted to share it so you can get the opinion of it. When you're looking at earnings growth, to me, the earnings growth is very important when you look at this on a fundamental basis. But if you look at the Mag 7, you're saying, okay, we're up, and now we're starting to come back to that 20% level. But at the same time, we're seeing these other quarters not do so great. The argument that they're making and what other people are going to make is that these are getting closer and closer. Yes, there's an argument for that for the Magnificent Seven. Are they done because they're getting closer to closer? I think if fourth quarter looks like this and third quarter looks like this, where you're 13 to 24 and 20 to 17 in comparison, yeah, I do think that you're going to see the other sectors. That we're going to look at the RSP here in a second. And yeah, I do think that that's going to be a problem for the Magnificent Seven. And I do think that they've been some of them have been a little heavy lately, and we're going to get to that. But I like the idea of working in more of this during the week, except for Saturdays. And this really stood out to me, so I really wanted to share it. If you look at the top 10 current names, you're at 29.8. The average is 26. Percentage, 145. Remaining stocks, 18.6, 5, 15.7, 115. What I would say about these top 10 is if you take Tesla out, this thing skews insane. It's absolutely skews insane. S&P right here, 21.5, 16.6, 129. If you take Tesla out of this grouping, it skews much lower than this. By points, not by decimal points. Just keep that in mind. And it does look, and we are going to go through this tonight with Tesla. Now, we're going to talk more about this on Saturday and what it really means. In 98, you can see here that you have this huge dip. And why? Why do you have that huge dip here in 98 and you have the same dip here? You're going to see this and you're going to start seeing it more and more. All of a sudden, you're seeing Saudi Arabia come out and they're starting their own AI chip company. There was another company that's coming out. You do not have the names that are going to be the real leaders yet going forward throughout years that are out there yet. You have very limited ideas. You need these IPO spikes. You don't have the IPO spikes. You are at least 2 years, in my opinion, from seeing those IPO spikes. So when people think that you're through this cycle, I don't think you're anywhere near through the cycle. I think you might be through part of the hyperscalers, which are your Microsofts, your Googles, and they're that Magnificent Seven that we're talking about. Some of the others really stick out. But I really look at this and I feel very, very comfortable with what I'm seeing here. And I really think that this is something that people are grossly underestimating. And you'll remember this slide because we're going to pay attention to it on Saturday. And I'll show you what I mean by this in greater detail then. I want to point this out. It's by Bank of America, and it's going to tie everything together here in a second. See where you were in December, where you had the lowest monthly market breadth on pace, all-time lows. And that was clearly going to be the bottom of the market, and the whole bottom of the market was going to fall off. That's what we were told. And everyone's going to say, but before in 23, we had the lowest breadth. And then in 22, we had the lowest breadth. Then in 18, right, over and over again, and they're all going to equate it to 2000. But what you're going to remember is you're going to remember the very first slide that we looked at this evening. You're going to remember the cash flow, and you're going to remember cash flow margins. And whenever anyone does a comparison, you're going to say, well, the margins back then were half of what they are right now. And they're either going to understand that explanation or they're not. But that doesn't mean that these can't come back in if margins go sideways, as we explained, and then we'll see the rotation. Let's talk about that. Now, at the time of recording this, SMCI issued their statement, and I just think it's important to go through this because this is going to play into what we've just been discussing. So I just want to go through these headlines. While I'm recording this, the conference call is going on, and if more comes out, I'll discuss it. But I just want to go through this before we get into some of these names. Supermicro preliminary earnings expects file delayed to come in the next couple of weeks. They've been saying that forever, so is Christmas. Here's where it gets interesting. They're announced the private placement of $700 million, convertibles at 2.25%, amendments existing to zero convertible senior notes due 2029. Announces amendments to existing zero convertible due 2029. Now, this is where it gets interesting. For them to do a convertible senior note at $700 million, they have to have already talked to the street and know there's demand. For there to be demand for this product, that means that someone has had to take a look at these books on the investment banking side and said, okay, they have X, Y, and Z, and we're comfortable with it. Or they wouldn't do the deal. I'm not saying that everything's fixed and everything's rosy, but someone had to do a level of due diligence before bringing this to institutional investors. They just wouldn't do that. They're not going to risk their reputation over something like a 5% fee on $700 million. It's not worth it to them. So I do think that this is really important. And I do think it's something that people are getting after hours. If you understand this side of the business, the institutional side of the business, you'd pick this up. No firm's going to go out on a limb and do that. They're just not. The other thing that was interesting is they're lowering revenue outlook from the 26 to 30 to 23 to 25. Now, why I think that's so fascinating is if they were going to stay and deal with the hyperbole of the entire situation, they might have stuck here and even raised or done something goofy, right? What they're saying is they're lowering all expectations across the board and saying, hey, we're going to just lower expectations and we're just going to outperform. And that seems to be the way the call's going right now. And I think that's interesting. And they're talking about net sales between 5 and 6. They're giving you a range and they're saying 46 to 62. Preliminary quarter between 58 to 60. Net sales 5.6 to 5.7. So when you're putting all these pieces together, it's becoming very clear to me that they might start having it together. And I'm not the only one that's feeling it that way. Now you can see after hours, the stock is trading up as we're talking and the conference call is going on. So it does seem like we're getting there. If I click the simplest of buttons, like right here, you can just see this is yesterday's close. So what I always like to do with this kind of stuff is I want to watch today's close. And as soon as we lifted that, we knew. We actually bought right in here when we read the report because everyone was panicked. And you just got that net jag down and everyone's like, oh, good. Well, if everyone in your sister's short, and everyone goes to cover, you're stuck, guys. You don't know anything anybody else didn't know. What you want to watch is what we have going on right now, which is yesterday's close. And that's an area where you would wind up getting out of the way if you were concerned. I'm not concerned at this point. We'll see how it acts in here because it's yesterday's high and yesterday's close. And if you get through that, you're going to push. Now, before we go any further, we might as well just talk about some levels here because I think this is going to be important for those that want to play this tomorrow. You can just see 48's the critical level. You start getting up to there, you're getting into the gap down. That's obviously of significance because this is where it all started. And then we just completely and utterly imploded right from there. You can see the earnings and et cetera, but the real implosion was right here. If we get in there, we gap filled, couldn't hold. If we can get back up there tomorrow to that 48, and we'll see how it goes. Right now, the conference call is going very well. I have a bias. I mean, we're long, so it is what it is. But we've done very well with it today and obviously after hours. You're going to just have to see how it acts tomorrow. Consistently speaking, if the earnings are real, this is so funny to say, but if it's true, I mean, you're trading at 10, 12 times earnings, which is kind of insane when you really think about it. But let's keep the ball rolling here. The purpose is to look at this and say, are we in a situation where these big guys are going to continue? And, if you look at earnings, after these earnings calls on Microsoft, you absolutely imploded. So I think there's a couple here that look fairly decent. But the Metas, the Googles after earnings, they weren't great. In other words, and we talked a little bit about this on the earnings day, but the Microsoft Azure sales were down. They did not hit the high end of their cloud numbers. Google did not hit the high end of their cloud numbers. Amazon did not hit the high end of their cloud numbers. Even though they crushed across the board, all these names dropped on earnings. So the question really is marking those levels off from earnings and see if we can get over those levels. Now, if we can, great. If we can't, then we can't. So I think it's really important to get that. And I do feel that that is where we're going. Now, a couple of cool things are happening. Number one, Apple's coming out with a new phone, and that phone is $499. It's cheaper. And that's going to allow them to get into different markets. It actually will help them greatly with what's going on in China and the subsidies with China, their ability to compete with it. What I really like here is that they do have that footprint. Now, the other names, they do have a footprint of billions of people use their product. I mean, you're in an ecosystem. It's very hard to get out of. I do think eventually it catches on, but for other reasons. I don't think Apple's the problem with the Magnificent Seven. I'll tell you where I think you have two outliers. Number one, I think Tesla's in tremendous amount of trouble, and everyone's going to look at this and go, geez, thank Rocky. I get it. But when we talked about these levels for some time, this was the production low when the production numbers came out, and for some reason it bounced on that because there's so many short people. Here's where Elon said everyone's getting, a veggie smoothie. Your robot's going to be able to do everything. It's going to go to work for you. It's going to drive you to work and work for you. And then obviously we gapped down and then we just fell apart, right? Okay. So when this happened, that just trapped a lot of people. The next day, you can obviously see how that played out, right? And this is what you walked into from that day where you fell down and then in reality started to settle it. So when we look at names like Tesla right now, if you break here, which it pretty much looks like it's going to happen, and it's interesting because when you think it should break, it doesn't, and then eventually it does. But you're breaking key levels, and any other name usually would have fallen apart, and that's why you didn't expect this one to, which is kind of funny. But you're holding this level right in here, and if you can hold that, great. But if not, you're really looking at 309.28. You might want to remember that. We're going to go through that tomorrow. And I do want to make sure that you guys do remember that you do have CPI tomorrow as well. And that's going to tie you directly into our level right here, 270. And then if that breaks, you're down at 242. People were saying, I don't think that could happen. Yeah, this is the one. This is the outlier on the PE. And then the next one I think is worth covering is Meta. And everyone's all giddy because they're saying Meta's higher highs every single day, yada, 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 since earnings. Yeah, I mean, they're kind of the outlier here because they're the ones that are really winning the race with the open protocol. And that's why it's acted completely different than the other names since earnings. Even though you had your one down day here, you bounced, and then from there it's just been pushing. It's the application names where the money is going. But let's get to CPI. Now, to start with, the Fed chair spoke today. They asked him a bunch of silly questions. One person acted like it's the end of the world. The other person acted like he's the greatest thing in the world. It is. For us, really, we're just going to go to Wednesday and focus on these numbers. Core inflation, 0.2 versus 0.3, 0.32, 0.4, 0.29. You're basically in line. And then we have Powell who's going to speak after it. And we'll go from there and we'll see what those numbers are. But there are some important developments. I just want to point this out so that we're on the same page that you have seen the inflation drop, hit that September low, which was right around the election shocker. And then you go 2.6, 2.7, and now we're back to 2.9. So are we going to see these quarter over quarters keep swinging up? And the answer is we really don't know that, but we can get some sense of this. I'll show you how. One of the things I like to do is look at crude oil, and then I like to look at gas. And the reason for that is it gives me an understanding of what's going on. So if we do just the simplest of things here, we'll just leave this in stage rolling mode. And really we just go to January 1st. And there we go. And then we look at that particular time, and then we look at where we would be from, let's say, go to January 31st right there. And then we look at this area and say, okay, well, we're up. Drop a VWAP from there, and you're going to see that the average price from here to here is going to be pretty substantial. So really what you're doing, and the easiest way to do this, is just take from where you opened in January to the average price on January 31st, just the average. And you'll see that oil on average from a volume standpoint was up about 5.8%. Now to put this in perspective, oh boy, it's getting goofy. But now to put this in perspective, what we would do is we'd go back and look at December, and we would just mark December off to the same period in time, which is where you're starting here on the 31st. And what we would do is just drop a VWAP in the same place and go, okay, well, from that standpoint over, how much were we up? And then what this is doing for us, and it's a really back of envelope way to do it, but okay, we were up 2% there on crude oil on average from the month. So you're up twice as much on crude this month in January as you were in the previous month. And then you just go back of envelope. And again, crude is in everything. Gas is in everything. Even though they say it's not, it is. It's just in everything. If we go and take a look at this and we do the same exact thing here, and we drop it down here, and then again from December over, and sometimes this number is a little different because of refining, so you always want to do both. Let's just come over and just drop it right here, and then we would see from there over, and then just measure. And go, all right, well, for December, you were at roughly a 2%, 2.19% increase. And then from the level, and take a look at Jan real quick and go, okay, well, where were we in Jan? And again, you still have all the refining. So it does make a difference in looking at the numbers this way. And come over to, there it is. And then you would come over and take a look at where you were on that date. And it actually looks like it's about the same, which is why it's always good to measure both. And this is actually less on gas than it is there. So crude's a little higher, and then we have gas that's a little lower. Crude's really the big weighting area that we would focus on. So for me, we want to see what happens and go from there. But if this is higher, you could see us come in pretty hard. And so I would not sleep on this. And the reason I say that is if you took a look at what happened on Friday on that Michigan consumer sentiment data, we dropped really hard. So we'll be live tomorrow at 8:30 from that, and we'll go from there. That is it.